If you're 62 years old with $800,000 sitting in your 401k, you've probably heard the advice about missing the 10 best days in the market being the biggest risk to your retirement. For someone actually retiring in 2026, that advice is close to a lie. Here's why. The people repeating that line are usually the same people earning a fee on every dollar you keep invested. They run the same playbook whether you're 25 and adding money every month or 62 and about to start pulling money out. Those are two completely different math problems, and the difference has a name. It's called sequence of return risk, and it's the part of the story most advisors leave out. A 30% crash in your first 24 months of retirement doesn't just hurt for a while and bounce back. It can shrink how long your money safely lasts by 11 years, even after the market fully recovers. That's not a rounding error. That's the difference between running out at 78 and running out at 89. I want to be clear about something. Wanting to protect what you built isn't being a doomer. It's not panic and it's not paranoia. It's about protecting the identity you spent 40 years earning, the identity of someone who never has to call their kids and ask for help. So over the next few minutes, I'm going to walk you through what I call the sequence of return shield, a 5-year cash bucket approach that actually beats staying fully invested once you're the one taking withdrawals instead of making them. We'll start with the math the big banks would rather you never sit down and do. Here's the number that standard advice skips over. A 30% loss doesn't need a 30% gain to get back to. Even it needs a 43% gain. That alone should give you pause. But if you're also pulling out 4% a year to actually live on while that recovery is happening, your real hurdle isn't 43% anymore. It climbs past 60% because you're selling shares to pay bills at the exact moment those shares are worth the least. That's the part nobody explains clearly enough. In your working years, a market drop is almost good news. You're buying more shares at a lower price every single paycheck, and people call that dollar cost averaging. In retirement, the mechanism runs backward. When the market falls 20%, and you still need your $4,000 a month, you have to sell more shares to raise that same $4,000. Each sale locks in a loss you can never earn back on those specific shares, even if the market eventually recovers everything else. I've watched this happen to people who did everything right for 40 years, then lost a chunk of it in the first 2 years after they finally stopped working, right when they had the least room to absorb it. There's another reason the ground feels less solid than usual right now. Market analysts track a long-running measure called the Shiller-Cape ratio, and it currently sits well above its historical average. That matters to you specifically because a stretched valuation doesn't mean a crash is coming next month, but it does mean the cushion, the margin of safety, is thinner than it's been in a lot of past retirements. Let's be honest about what this actually is. You aren't a market timer for wanting to protect your principal. You are a risk manager for your family's future, and there's nothing reckless about that instinct. Picture two people withdrawing $4,000 a month from a $700,000 portfolio. One retires into a flat market. The other retires into a 20% drop in year one. 10 years later, the first person still has money left. The second person, withdrawing the exact same amount at the exact same rate, runs out 3 years earlier. Same discipline, same withdrawal rate, completely different outcome because of when the drop happened, not whether it happened. But here's the trap on the other side. If you panic and move everything to cash, inflation quietly eats your buying power every single year you sit there. So how do you stay invested enough to keep growing without turning into a forced seller the moment the market drops? That answer isn't a feeling or a guess. It's a specific if-then plan, and that's exactly what we're building next. The fix isn't guessing whether a crash is coming. It's building a plan that already knows what to do the moment one starts. I call it rules-based rebalancing, and it runs on two simple triggers instead of a gut feeling. The first trigger fires when the S&P 500 drops 20% from its peak. At that point, you stop pulling any money out of stocks completely, and every withdrawal instead comes from a bond ladder you built ahead of time. The second trigger fires if the drop reaches 40%. At that point, you actually do the opposite of what feels natural. You sell 20% of your bonds and use that money to buy stocks while they're cheap. The rule makes that decision for you, so fear never gets a vote. These two numbers aren't random. A 20% drop is the traditional line, where analysts start calling a decline a bear market, and history shows most bear markets bottom out somewhere between 20% and 50% before turning around. Building your triggers around those levels means you're reacting to a pattern that's shown up again and again, not to a headline that scared you on a random Tuesday. The reason this works isn't magic, it's sequencing. By refusing to sell stocks during the worst of the drop, you give your shares time to recover before you touch them again. And by using the crash itself as a buying signal at the 40% mark, you're doing exactly what disciplined investors have always been told to do: buy low, except now you have a rule that makes you actually do it instead of just admiring the idea from the sidelines. Picture a $1 million portfolio built this way, instead of the usual 60% stocks and 40% bonds split. You'd hold a 3-year cash reserve of $150,000 and a 7-year bond ladder worth $350,000. A bond ladder isn't just one big pile of bonds either. It's built so a chunk matures every year for 7 years, which means you always have cash coming due right when you need to spend it, instead of being forced to sell a bond early at a bad price. That's $500,000 sitting outside the stock market entirely, enough to cover 10 years of withdrawals before you'd ever be forced to sell a single stock at a bad price. The trade-off is real. That cash and those bonds will earn less than stocks over a normal 10-year stretch. But that lower return is the price you pay for never having to sell your S&P 500 shares in a panic and over a full retirement. That protection is usually worth more than the extra growth you gave up. I used to tell people a 60% and 40% split was good enough. Full stop. Then I watched what happened to my own neighbors in 2008. A couple of them had to go back to work at Home Depot at 65, not because they wanted to, but because their portfolio couldn't cover the gap. That's when I stopped believing diversification alone was a plan. A withdrawal schedule is the plan. Diversification is just one piece of it. If you're realizing right now that your advisor has never actually given you a written break-glass plan for a 30% drop, that's worth sitting with for a second. Hit subscribe, because this channel is built around retirement cockpits, not just portfolios, and we walk through exactly this kind of plan every week. History already ran this experiment once. Between 2000 and 2010, the S&P 500 delivered a total return close to 0% for the entire decade. Someone who retired right at the start of that stretch and needed their portfolio to fund a normal life waited 10 full years for the market to simply get back to where it started. If you lived through 2008, you already know that long-term feels completely different at 67 than it does at 37. At 37, A lost decade is a bad chapter in a long book. At 67, it can be most of the book you have left to write. You don't get to tell your bills to wait 10 years for the market to recover. A lost decade isn't a random accident. It usually follows a stretch where prices climbed faster than the earnings and wages backing them. And eventually, that gap closes one way or another. That's part of why an elevated valuation matters now, not because anyone can call the exact top, but because the math around it tends to even out eventually. And some of your bills don't care what the market is doing at all. Take your Medicare Part B premium. In 2026, the standard premium runs $202.90 a month, and it comes out of your account, whether the S&P 500 is up 20% or down 20%. That's not a number you get to negotiate with, and it's exactly the kind of fixed cost a 5-year cash bucket is built to absorb without touching your invested shares. That's exactly the setup sequence of return risk punishes hardest, a portfolio that goes nowhere for years, while you're still pulling money out of it every single month. It's not a prediction that this exact scenario repeats. It's a reminder that it already has, more than once, well within living memory. Ask yourself honestly how your monthly budget would hold up if your portfolio simply sat flat for the next 10 years, starting right now. So the real question isn't whether a lost decade could happen again. It's whether your plan survives one without forcing you to change your whole life. That's what we're about to stress test. Let's run a specific scenario instead of talking in the abstract. The market drops 25%, and at the same time, inflation holds steady around 4%. That combination, a falling portfolio and rising prices at once, is one of the harder tests a retirement plan can face. Picture two people, each spending $5,000 a month. The first one has no cash bucket. Every month, they sell S&P 500 shares to cover that $5,000, which means they're selling more shares than usual because prices are down and everyday costs are up. Their withdrawal rate effectively doubles in real terms, and every share they sell locks in a loss they can't undo later. The second person built the shield we've been talking about. They're sitting on 3 years of cash in something boring, a high-yield savings account, or short-term treasury bills. For 36 straight months, they don't sell a single share of stock. They just live off that cash bucket, while the market has time to do what it's done after every other crash in history, recover. Social Security helps here, but only partly. The 2026 cost of living adjustment came in at 2.8%, which is real money, but it's nowhere close to covering a 4% inflation gap on its own, especially once you add in rising costs like healthcare that tend to run hotter than the official number. Ask yourself honestly, if the market dropped 25% tomorrow, how many months could you go without selling a single share to cover your bills? If the answer is 0, that's not a character flaw, it's a planning gap, and it's fixable long before any crash actually happens. Most people assume the cash bucket is about earning a better return. It isn't. Our job is to buy you the one thing money usually can't buy once you're retired, which is time. Time for the market to recover before you're forced to touch it. That kind of start can turn a portfolio built to last 30 years into one that's stressed by year 15, even after prices eventually recover, because the shares sold at the bottom never get the chance to participate in that recovery. That's the entire gap between the two people in this scenario, not luck, just 36 months of patience. Knowing the plan exists is one thing. Actually trusting it while your account balance is falling in real time is a different challenge, and that's the part almost nobody prepares for. There's a specific bias that hijacks people the moment a crash actually starts, and it's called action bias. Your brain sees a red number on a screen and screams at you to do something, anything, right now. Sitting still feels like losing control, even when sitting still is exactly the right move. This matters more the closer you are to retirement, because you have less time and less new income to absorb a mistake made in a panic. If you've ever watched $200,000 disappear from an account balance and felt genuinely sick to your stomach, that's not weakness, and it's not a character flaw. That's your survival instinct doing exactly what it evolved to do. It just wasn't built for a stock market. It was built for physical danger, and it doesn't know the difference. Here's a small shift that changes how that feeling lands. Stop checking your account balance every day and start checking your months of liquidity instead. If you know you're sitting on 60 months of cash and bonds outside the stock market, a bad week in the S&P 500 stops being a threat. It just becomes noise, because you already know exactly how you'd cover the next 5 years without selling anything. That one number, months of liquidity instead of dollars lost, is often the difference between a retiree who sleeps fine during a crash and one who calls their advisor 3 times in a week. It's not about caring less. It's about measuring the right thing. It's worth naming that financial media doesn't help either. Headlines are built to spike your anxiety because anxious viewers keep watching, not because the underlying situation actually changed overnight. That gap between what the headline wants you to feel and what your actual plan requires is worth remembering the next time the market has a bad day. Once you trust that number, the next step is making sure it's actually funded before you ever need it. This part is simple on purpose, because a plan you can't actually execute isn't a plan. Start with what I call your gap number. Take your total monthly expenses and subtract whatever Social Security or pension income already covers. Whatever's left over is the number your cash bucket has to fill every single month. And it's usually smaller than people expect once they actually do the subtraction. Most people have never actually written this number down. They know their portfolio balance to the dollar, but they couldn't tell you their real monthly gap if you asked them right now. That single number is what your whole shield gets built around, so it's worth taking 15 minutes with a pen and an actual bank statement instead of guessing. Next, fund your 3-year cash reserve. If you're still working, this is where the 2026 contribution limits actually help you. The base 401k limit is $24,500, and if you're 50 or older, a catch-up contribution brings your total up to $32,500. If between 60 and 63 specifically, you get an even bigger catch-up, pushing your total closer to $35,750. Every extra dollar you route toward stable assets during these last working years is a dollar that doesn't have to come from selling stock during a future crash. Say your gap number comes out to $2,500 a month. Over 3 years, that's $90,000. You need sitting somewhere boring and safe, not exposed to a 25% swing the week you need to spend it. Third, use the tax rules already on the books to your advantage. Starting in 2025 and running through 2028, anyone 65 or older gets an additional $6,000 deduction, or $12,000 for a married couple both over 65, though it phases out at higher incomes. That deduction can help offset the tax bill when you rebalance a stock position that's grown into an oversized chunk of your portfolio, moving some of those gains into the bonds and cash that actually protect you. Here's why that matters beyond the deduction itself. Selling an appreciated stock normally triggers a capital gains tax bill, and that tax bill is one more reason people put off rebalancing until a crash forces their hand anyway. Using this deduction to soften that bill removes one of the excuses for waiting. There's one more piece most people never hear about, a specific rule the government actually built in your favor to help you avoid selling stock at the bottom, and it runs through your required minimum distributions. That's a deeper conversation on its own, but it's worth knowing it exists before you assume your only options are sell low or sell nothing. None of these three steps require predicting anything. They just require doing the arithmetic once, and then actually funding what the arithmetic tells you. Here's the whole idea in one sentence. You don't need to predict the next crash. You need to be crash-proof before it happens. For someone actually taking withdrawals in retirement, a 5-year cash bucket beats staying fully invested and hoping you don't miss the 10 best days every single time. I don't have a crystal ball. I don't know if the next crash lands next year or shows up years from now. But I do know I'd rather be 5 years early building this shield than 5 minutes late, realizing I needed one. That's the difference between reacting to a crash and already having answered it months, sometimes years, before it ever shows up on your screen. This channel exists for exactly that kind of planning, the boring, unglamorous groundwork that makes a crash a non-event instead of a crisis. None of this requires you to be a market genius or to check prices every morning. It just requires deciding once, calmly, before anything goes wrong, exactly what you'll do if it does. That decision, made now while everything is calm, is worth more than any prediction anyone could sell you about when the next crash actually arrives. If you want the specific if-then checklist we walked through today, hit subscribe and join the people here who are building this out for real. Your retirement should be defined by the choices you made ahead of time, not by whatever the market decides to do next.